So in terms of our structure today, I'll hand over to Jonathan. We'll have Tom do his presentation and really encourage anyone that would like to ask questions to just log those online, and then we'll facilitate that. Presentation will go for around about 45 minutes and that should allow us around about 15 minutes to have some questions. So welcome to everyone on behalf of Prime. Thank you for joining us, and I will now hand over to you, Jonathan.
Great, thank you, Simon. Thanks for everyone again who's logged on and who I guess will still be logging on in the next couple of minutes. We're thrilled that we could get some time in Tom's diary to do this presentation. Tom King is the Chief Investment Officer at Nanuk Asset Management. For those of you that have been investing with us for a few years, it's quite likely that you are aware or hold a position in Tom's fund. And we think the coming couple of years will be really exciting in terms of the potential performance from investment in environmentally efficient, sustainable technologies, and happen to think that the potential for a change in the US presidency in just over 100 days could be a really interesting catalyst for a surge in green investment. I don't want to steal Tom's thunder because he's the expert, and probably most of you are sick of hearing the sound of my voice over the last couple of months. But some really interesting policy platforms outlined by Joe Biden for his likely implementation if made the president. And perhaps the reason why I'm focusing on that just in a modest way at this early point is that yes, he's ahead in the polls, but he's very strongly ahead in the betting, which I think is a strong guide for the likely election outcome at this early point. Obviously, there's a long way to go, but it does look very strongly in favour of him potentially being the new president. And as I say, the policies that he's got to put in place, I think, will be really important for portfolios in a manner of ways, but most particularly on the green energy side. Tom and I were just chatting before you all came online about the announcements out of Europe last night too, where a huge amount of capital is likely to be invested in green and environmentally efficient technology. So the opportunity set is a really big one, and there's really very few investment managers that have the skill set and time in market, if you will, in this particular sector. So I would really encourage any questions that come up along the way. Log them please in the questions box. I've seen the presentation from Tom, and I think you're really going to enjoy it. Be really informational and interesting, and hopefully we all get a lot out of the good fortune we have of having Tom online. So maybe without further ado, I'll hand over to Tom King, and he can tell us a bit about Nanuk and a bit about the way the portfolio is set up and some of the good ideas that they have got currently invested in the portfolio. So maybe over to you, Tom.
Great, thanks, John. I hope that everyone can hear me clearly. I'm going to share a presentation that I'll run through today. What I've got here is really focused on what is the outlook today for sustainable technologies and investments in sustainable technologies post-COVID. It focuses less on the fund itself, but I'm very happy to obviously take questions on that, and we can follow up in more detail around that if people would like to after the call. The structure of this presentation is really in 4 parts. First, some introductory remarks, in essence a summary of our worldview. The second part is a bit of context around climate change policy globally and what the outlook there is. I'm then going to look backward at recent history, because I think what's happened in the last 10 years provides a very good framework for thinking about what's likely to happen in the next 10 and beyond. And then finally look at what's actually happening today in terms of policy developments that are likely to drive and accelerate investment in sustainable technology going forward. For those of you who aren't familiar with our fund, we run a global equity fund. In most respects, it's a pretty straightforward proposition. It's a geographically diversified 70 stock portfolio and relatively straightforward in terms of its risk profile. It's performed well historically. Hopefully we can continue that going forward. What really differentiates it is that as a firm, we focus on a specific set of industries and technologies. And that goes to the firm's philosophy and our views about what is going on in the world. And they're pretty simple. When we started Nanuk 10 years ago, we had a view that economic growth globally, ongoing population growth, ongoing economic development, rising levels of consumption, simply weren't compatible with the already evident set of environmental and resource constraints globally. And our thesis has always been that one way or another, large parts of the global economy are going to have to change very significantly over time to reconcile those two things. And on top of that, there's a set of factors that are facilitating the sort of adoption of a broader range of sustainable technologies, government policy, the emergence of new technology solutions, but primarily the improving economics of a range of existing solutions. And our thesis can be represented in the way it is on the slide I'm showing now, which shows across the broader economy a set of sustainable technologies that we think are likely to be adopted on a very widespread basis over the coming decades. Some of those areas have already seen remarkable progress, particularly in the last decade, areas like solar and wind energy, a number of the energy efficiency technologies, things like LED lighting, more recently battery technology and electric vehicles. But as we move forward and the drivers for change become stronger, we expect a much broader range of technologies to be adopted. And our focus as a firm is on investing in those areas, in industries that are contributing to improving global sustainability, and it's broadly the 8 areas shown on the slide there. And they're, or the reason that we've chosen to do that is that they're all very interesting areas for investment, and particularly for active investment. They're, generally speaking, parts of the economy that over time you would expect to grow faster than the broader economy, which is a good starting point. But on top of that, what's going on in those areas and the broader industries in which they sit is interesting and complicated. It's influenced by changes in government policy, it's influenced by shifts in technology mix, it's influenced by changing market shares, and those kind of changes are generally not very efficiently priced by the equity market, and that presents opportunities for people like ourselves who can develop expertise and some insights into what's going on, and hopefully leverage that by picking companies that might benefit from that. And there's already quite a body of evidence to back up what we do. The chart here is a simple slide that shows the long run 20-year performance of the MSCI World Index at the bottom compared to a FTSE Russell environmental index that we use as a benchmark and a proxy for our funds investment universe. And you can see there that index is gradually but quite significantly outperformed over time. That's been driven by a number of factors, but the early outperformance in the late 2000s was driven by a shift in government policy in Europe, where they started to promote renewable energy and energy efficiency solutions much more heavily. And since then, it's had a little bit more to do with the sort of decline and underperformance of other parts of the economy, many of which have started to suffer as a result of some of the same changes. And our view is that over the long term, that trend is likely to continue for the same reasons that it's occurred historically. And we're at a very interesting point now where you're starting to see a repeat of some of the policy sort of decisions that were made 15 years ago. But to emphasise, this is not all about government policy. This slide, which I won't go into detail on now, attempts to illustrate that across a very broad range of the areas that we look, what we see is very significant and rapid declines in the cost of technology solutions that mostly have been around for decades in niche applications, but as their costs come down, they become more economically viable and adopted on a more widespread basis. And ultimately, it's that economic driver that will see the transition in the electricity sector towards renewables, which are now, on a very widespread basis cheaper than coal and gas. And that will get repeated. So with that worldview, our investment approach is pretty simple and relatively conservative. We like to buy what we think of as good quality companies, which are typically mature, profitable businesses with some form of competitive advantage that generate good return on capital. We like to try and identify that type of business at points in time where they're likely to benefit from the way in which their industries are evolving. And then ultimately we seek to buy companies at prices that make sense, that provide for potentially attractive returns on a forward-looking basis. And that, in combination with our investment universe, leads to investments in a portfolio of companies that'll be quite different to what many of you will hold in other or through other funds or directly. And that's, generally speaking, a good thing from a portfolio perspective. In terms of the big picture, I don't generally like to talk about climate change, but because our firm exists for investment reasons, not because we're environmental zealots, but it is a very important driver in terms of where the world is going and the way policy decisions are being structured. And we did a big seminar last year around this, looking at what are the implications of the adoption of long-term climate change targets, related targets. And the starting point for that is to look at what the problem is. Where are greenhouse gas emissions coming from? And that's shown in this slide. Interestingly, you'll note that the areas that have been focused on today, which are electricity generation and passenger vehicle transport, really represent only about 1/3 of the global problem. That agriculture represents about 1/4 of greenhouse gas emissions, and that's a very complex area to deal with because that comes from a wide variety of different sources that are not easily addressed. And another large component comes from industry, which I'll touch on in a little more detail. And most of the cause of most of those emissions is the use of fossil fuels. That shouldn't be surprising. But when you look into what might be done to address those problems over time, what's interesting is that in almost all cases, the solutions are quite clear. They're technology solutions that exist today. The challenge being that in most cases, the cost of adopting those solutions today is prohibitively expensive or perceived to be prohibitively expensive. In much the same way that solar and wind energy were perceived to be prohibitively expensive 10 and 15 years ago. But the solutions are all there and straightforward. And from a big picture perspective, one of the things that gives us great confidence that what we're doing is going to have a long sort of runway of potential success is the way in which policy is evolving globally. And before COVID happened this year, the major sort of policy discussions globally were all centered around climate policy and in particular around the adoption of 2050 net zero carbon emission targets. And a number of countries, sizable, influential countries around the world have now adopted into law those targets. Others have adopted them in regulation, and there are dozens of others who are likely to do so in the near term, and certainly as sort of the issues of COVID pass, that'll very likely once again be a focus. And if you look at that as a sort of background to what's going on, and the fact that governments are going to deploy large amounts of additional stimulus funding and use their regulatory power to help stimulate the economy, a lot of that's likely to go into the areas that are the solutions to the causes of the problems I just touched on. And that is indeed what we've seen happen. In terms of history, I just wanted to look back quickly because there's some, rightful cynicism about whether this is a good thing to do, whether, putting money into areas that are, economically costly today is putting good money after bad. The framework for considering that is to look at what has happened in areas like solar and wind and LED lighting and automotive fuel efficiency and electric vehicles, which have all followed a very similar path of development over 10 or 20 years, from points in time where government started to set long-term targets and introduce policy measures to drive industries towards achieving them. And that has followed a very similar pattern where initially industries that have operated in small niches have grown very quickly at egregious levels of profitability through the first phase of stimulus support. But that's changed quite quickly as those industries have attracted capital and competition and developed economies of scale, which have seen costs fall and ultimately fall to a point where it becomes obvious that the trajectory of cost improvement will get you to a point of cost competitiveness with existing technology solutions. And at that point, you see quite profound shifts in market behaviour. And that's what we've seen over the last sort of 18 months or so in the automotive industry, where a decade ago, the thought of selling economically competitive electric vehicles was a wild dream. Through some policy support and guidance, the industry has started to invest in and develop electric vehicles. That's caused the cost of batteries to fall by 85 or 90% over the last decade. And that's a trend that's very likely to continue into the future. And a couple of years ago, it became apparent that on that cost trajectory, electric vehicles are going to reach cost parity with the equivalent internal combustion engine vehicles in the mid-2020s. And at that point, you saw businesses like Volkswagen and Daimler pivot their entire research and development effort away from internal combustion engines and to electric vehicles, and in essence ensure that that is the way that the industry will develop in the future. The other piece of history that I think is relevant is to look back to what happened after the global financial crisis in 2008 and early 2009. There were some very large economic stimulus packages around the world at that time. The largest one was in the US, the Recovery and Reinvestment Act. If you look at how that was deployed, the majority of it went into fiscal measures, tax cuts and fiscal support for states and municipalities. But of the remainder, the majority went into areas that were aligned with the sort of broad areas of our focus, things like improving energy networks and transport infrastructure and building energy efficiency and so on. And that's extremely likely to be repeated. And that funding was extremely effective. If you look back at what happened in the solar industry around that time, the policy measures that were introduced saw the scale of the solar industry triple over 3 years on a global basis. And that was accompanied by a halving in the cost of electricity generated from solar over that time period. It didn't instantly make solar cost competitive, but it put the industry on a trajectory where its growth has allowed that to happen subsequently. And that is likely to be repeated again. That didn't, and this is a sort of another investment related point, that didn't necessarily lead to great investment returns within the solar sector. And that's something that we're very cognizant of right now, particularly when you look at what's happened with companies like Tesla and Nikola in the US. And I can come back to those if people are interested. What has happened in areas like solar is that as the industry's grown, they've become more competitive, and costs and prices have fallen over time, and they're inherently capital intensive industries, and that's not been good for economic value creation and ultimately for shareholder returns at an overall level. But there've been lots of fantastic opportunities along that journey as sentiment shifted from enthusiastic to very pessimistic and back again, and as businesses have developed around that industry that are able to generate economic value and good shareholder returns. So with all of that as background, and I hope that's sort of interesting context, I wanted to look more specifically at what's happening around the world today. So until yesterday, the specific green stimulus announced has been relatively limited. We've seen trillions of dollars of stimulus deployed globally. Quite rightly, most of that's been directed into areas to do with social equality and social support, so directed towards businesses and people who've lost their jobs to keep people out of economic trouble. But as we pass through this phase, and we inevitably will, the stimulus will be directed more and more towards reviving economic activity. But yeah, at this point, only a relatively small amount has gone into what you might call green or sustainable technologies. If you look at where that's been deployed, most of it, or a third or so of it's gone into electric vehicles, both into subsidising the purchase of electric vehicles and into building charging infrastructure. You've seen another portion go into other forms of transport, particularly rail, to encourage shifts in modes of transport away from road and air towards rail transport. You've seen a number of energy efficiency measures announced, which I'll come back to. There's been quite a lot of investment in renewable energy, some of which is not included in these numbers. And then hydrogen's become an area of increasing focus. And once again, I'll come back to that. On a global basis, I guess the centre of environment policy, the leaders historically and again today are in Europe. And as Jono alluded, yesterday the EU came to an agreement on the economic stimulus measures that they are going to deploy over the coming 6 or 7 years. And they've been aligned with the premier sort of policy initiative of the EU at the moment, which is called the European Green Deal, which is a very wide sort of very broad set of initiatives targeted at completely transforming the European economy to be sustainable in every sense by 2050, including reducing their net emissions to zero over that time frame and developing a proper circular economy. The stimulus that was announced yesterday was the EU recovery plan. That forms or falls into two parts. There's a short-term funding mechanism of 750 billion euro, which is available to the EU member states, some of which will be given as grants to countries like Italy and Spain, some of which will be given in the form of borrowings to be paid back over a long period of time, as well as a budget for the next fiscal period for the EU. And that totals more than $2 trillion. That's been a very difficult thing for them to negotiate because they've mutualised debt at an EU level, which is a very significant step for the EU, but probably a very good thing from an investment perspective for markets more generally. But in coming to that agreement, they have really put climate at the front. In the announcement yesterday, there were a number of sort of steps forward that hadn't been in previous drafts. That includes a revision of the European Union's emission reduction target from 40% by 2030 to 55% by 2030, which is a huge step, and an increase in the amount of those funds that are to be specifically directed to measures to address climate change. So 30% of that fund, something like €500 billion to go into climate change related investment. And I've been sort of trying to get to more of the detail of it this morning, but I thought there were a couple of quite interesting measures that hadn't been flagged previously. The EU will seek to raise more revenue at a block level to help cover the cost of this, and included in the measures through which they might do that, a tax on single-use plastic, non-recyclable single-use plastic, and a carbon border tax. So if the European Union is going to become carbon neutral, they want their trading partners, including Australia, to do that. To the extent that we don't do that, they will tax our products to make that economic adjustment. But the single-use plastic ban is interesting for us. One of the companies we hold in the fund at the moment is a European business called SIG Combi Block. It's a sustainable packaging business. It's the number 2 in aseptic packaging behind Tetra Pak, which many of us will have heard of. The company sells not just the packaging, but the machines and systems and support to run that packaging. They have very good relationships with large clients like Nestle and Unilever and Danone around the world. And they're very likely going to be a beneficiary of a structural shift away from plastic packaging over time. And our view in relation to this company is in part supported by a strong belief that we would see increasing policy support that is really sort of absent around the world today, but not hard to implement, to shift things in that direction more quickly. And so that announcement's likely to be favourable for that company. If you look at Europe in more detail, actually it's not the European Union who's directing where climate change or sustainable sort of policy is going. It's happening at a national level. A number of countries around the EU have announced their stimulus packages or the latest rounds of their stimulus packages. Germany is the largest one of those. And you can see on this slide where Germany has chosen to deploy some of that stimulus funding. Their total package, I think, was about 130 billion euros. So it's somewhere around a third of that amount going into supporting more widespread adoption of renewables. Once again, electric vehicles, Deutsche Bahn's the rail network in Germany. And interestingly, they've made a very big commitment to developing what they call green hydrogen, so hydrogen produced from renewable energy sources. You'll hear about grey and blue hydrogen more and more. Grey hydrogen is produced from fossil fuels. Blue hydrogen is hydrogen produced from fossil fuels with the use of carbon capture and storage. And I'll talk about why hydrogen's important in a second. We've also seen some big measures in terms of support for the auto industry in Europe, in not just Germany, but France and Spain. And those measures have been tied to selling more electric vehicles, as well as developing a vertically integrated supply chain in Europe to manufacture electric vehicles. The US is a bit different. The US is in a political stalemate, particularly around things to do with environment and climate change, where Trump has sought to unwind many of the policy initiatives of the last president. And yeah, to some extent, he's been successful in doing that, although in terms of deployment of sustainable technology, most of it's dictated by what's happening at a state level, and the states have moved in the other direction. What has happened in the United States has been an enormous amount of stimulus funding deployed, $2 or $3 trillion, sort of announced measures of fiscal support. None of it's been directed towards sustainable technology. Most of it has indeed just gone to supporting fiscal measures. There's little bipartisan support apart from any for infrastructure and the sort of Made in America concept. There's a little bit of a prospect that we'll see some movement in those areas before the election, but I wouldn't hold out a great deal of hope. As Jono alluded, the polling is suggesting that there is a very real prospect we'll see a Democratic president, Joe Biden, in the White House, and perhaps not just that there is some chance that the Democrats could take control of Congress, which would have a profound effect. So Joe Biden last week unveiled his stimulus and environmental policies that involved around $2 trillion of expenditure over a 4-year term, and the adoption of very ambitious emissions reductions targets and renewable energy targets. Now, the details of that policy were very light, but it does give some indication of the direction in which he wants to go, and it's very consistent with some of the other policy proposals put forward by the Democrats in the House of Representatives recently. And so if we do head that way, there'll be a paradigm shift in the US in terms of support for sustainable technology. And even if not, it's hard to see how the Republicans will have control of Congress and be able to push through major stimulus measures without the Democrats insisting on at least some support in these areas. China's a bit different. China actually hasn't announced any green stimulus. In fact, they haven't really announced any direct economic stimulus, but they are doing things to stimulate their economy. What they did announce was 7 areas of focus for new infrastructure. That's the areas shown on this slide, the largest being intercity and metro rail, as well as other areas like building the electricity grid with ultra high voltage transmission lines, and then quite a lot in terms of digital technology and building out 5G and the Internet of Things. And we've already seen a big pickup in project approvals and project commencements in renewable energy and fixed asset investment in areas like rail over the last few months, and I'd expect that to continue. I won't dwell on Korea, where they've announced some similar sort of green measures. Japan's the other major economy, perhaps worth commenting on. They've announced large stimulus measures. I think it's a couple of $1 trillion in total now, but only a very small amount in terms of green stimulus directed at energy efficiency in public buildings. What they have done, interestingly, and this ties to what we might expect in the US, is that they are supporting firms to bring manufacturing back to Japan out of China, and they've now deployed, I think, about $500 million to 30 or 40 Japanese companies to help them rebuild manufacturing in Japan. And that, from our perspective, should be positive for investment in areas like advanced manufacturing and industrial automation going forward. Now, I realise I'm probably starting to drag on a little bit here, but I did want to touch on a couple of areas that I think are interesting and relevant now from an investment perspective. One is green hydrogen and industrial hydrogen, and the other is building energy efficiency, which, if you go back to the wagon wheel earlier, together necessary to address quite a large slice of the pie in terms of global emissions that hasn't been tackled in any serious way previously. Industrial emissions are a huge problem. If you look at industrial emissions globally, cement, iron and steel and petrochemical production account for more than half of them and about 15% of total global greenhouse gas emissions. If you look at what's causing those emissions, about a third of it comes from heating in industrial processes, which is burning coal and natural gas in processes to generate heat. And the other, or another third, comes from process emissions from using feedstocks like coal and natural gas that emit carbon dioxide or carbon monoxide or methane during those processes. And if you're in any way serious about lowering global emissions, those things need to be addressed, and they will need to be addressed using alternative feedstocks and through electrification of heat and using fuels like hydrogen to do that. And that's been well recognised. You're starting to see green hydrogen facilities being built. This is one in Japan near Fukushima. It's a 20 megawatt solar farm attached to a 10 megawatt green hydrogen plant. That's relatively, well, I think at the time it might have been the largest one in the world. It's relatively small in the context of what is sort of being contemplated. The EU has introduced a hydrogen strategy in the last couple of weeks that contemplates building 40 gigawatts. So, 3 orders of magnitude more than this by 2030. And that investment program totals something like $500 billion euros over 3 decades. It's a technology that is today economically unviable. The cost of green hydrogen is several times more than hydrogen from fossil fuels, and indeed, more expensive again than just using it as a substitute for natural gas within processes. That is almost exactly the same situation we were in a decade ago with solar energy being 5 or 6 times more expensive than coal-fired power. And today we're in a situation where solar power is the cheapest form of bulk electricity generation, and in most of the world now costs about half the cost of coal-fired generation. And the belief is that as green hydrogen cumulative production is scaled, the cost will come down in a fairly predictable way, such that it is cost competitive. It's not an area we've got a lot of exposure in the fund. It's been an area of very speculative investment over the last sort of 6 to 12 months. Any company with hydrogen in its name has probably doubled or tripled. We see that as quite similar to what happened in the solar industry, and needs to be approached with a great deal of caution. We do have holdings in a number of the large industrial gas businesses globally, including US-based Air Products and Chemicals, which announced what is by far the biggest green hydrogen project globally a couple of weeks ago. And the stock was up 7 or 8% on the day off the back of this. That's a $5 billion project in Saudi Arabia. The other area of big interest from an investment perspective that hasn't been tackled before is in housing. We've got globally a set of energy efficiency targets that have been progressively tightening around the world for new buildings, and today's new buildings are very energy efficient, and that's a great thing. But if you look at building stock globally, they account for only a very small proportion of all the buildings out there, most of which are emitting a lot of or using a lot of energy for heating and lighting and other things. And addressing that existing housing stock is something that's been really ignored, but is no longer able to be ignored. And in Europe, as part of their Green Deal, they're looking to dramatically increase renovation rates from less than 1% of housing stock a year to somewhere between 2 and 3% a year, which will see the entire housing stock renovated to become energy efficient over a period of a couple of decades. And that will be very positive for companies involved in areas like insulation and in building energy efficiency systems and building control systems. And those are areas we have some exposure. So in summary, before perhaps we open up to questions, if you go back and look at the way in which we were anticipating the world might evolve before COVID happened, there are a good deal of those areas that are likely to be accelerated, or those transitions are likely to be accelerated or brought forward in time as a result of what's going on and what we're likely to see in government measures deployed over the next 3 or 4 years. And that's great for us in terms of presenting an ongoing interesting opportunity set. The other part of this that I haven't really touched on is around changes that don't relate to what's going on in governments, because we think there are likely to be some significant changes to business practices as businesses seek to build more redundancy into their supply chains, to localise manufacturing, to adapt to a work from home type world with greater reliance on automation and cloud-based services and so on, and seek to improve the efficiency of their businesses as they always are. And then on the consumer side, it's a little less clear what's going to happen, but there is some evidence to suggest that consumers are going to behave a little differently and with a little more emphasis on sustainability and perhaps recycling and reuse. And once again, that will play to some of the areas that we're focused on and invested in. And I haven't spent a lot of time talking about the portfolio and stocks, but just to give some colour to what we are doing, there's a selection of companies here that we're invested in at the moment, doing a variety of interesting things that are likely to benefit from the way in which the world is evolving. So Keysight Technologies is a testing and measurement and design technology business that provides equipment used in the design and testing of wireless devices and networks, particularly things like 5G devices and 5G networks, and is seeing a big benefit from the investment in those areas. Lensing, quite differently, is a sustainable textile business that is likely to benefit from consumer shifts and business shifts towards the use of more sustainable input materials. TE Connectivity is a relatively boring industrial business that, as the picture shows, makes connectors, but stands to benefit from increasing industrial automation and electrification in transport, where its products are widely used. Legrand's a French company that makes low voltage electrical equipment. It's a leader in sort of building electrical equipment, things like building control systems. That company is certainly likely to be a beneficiary of the sort of directed increase in renovation rates in Europe. SIG Combi Block I talked about. Ocado is an online grocery business in the UK, but its real value is in its automated online order fulfillment technology. It's developed automated warehouse technology that it's now selling to grocery chains around the world. And that, with the uptick in online retail, has performed very well over the last couple of quarters. Carlisle's a multi-industrial US business, but its primary business is in making building insulation for industrial buildings. CRSC is a China Rail and Signalling Corporation, makes control systems and signalling systems for high-speed rail. Its primary markets in China, where investment in those areas is picking up as a result of stimulus. Keysight is a Japanese industrial automation business that makes sensors used in automation, particularly visual sensors or optical sensors. It's a leader in its space. And finally, PerkinElmer is a diagnostic business, and it had pre-announced its results a few days ago, and a quarter of its, it had grown its revenues by, I think, 25% for the most recent quarter, largely off the back of increased healthcare testing around the world because of COVID. It's actually quite a diversified business with testing in areas like sort of environmental testing and food testing, and business with a good growth outlook longer term. So what I might do there is, now that I've gone on for so long, stop talking myself and go back to Jono and perhaps open up to questions if there are any.
Great idea. I've just tried to get my video up and running again, and having the same problem we had earlier, Tom. So you can't see me, but hopefully you can all hear me. I've got a couple of questions, if you don't mind me asking, just in lieu of any from the audience. But I think, you know, the one blue ribbon environmental stock that everyone's been aware of late is Tesla. Yep. And I know the fund has had an exposure to it, and it's, you know, probably surprised most, I think, in the market at the extent to which the share price has run. Do you have any thoughts or comments ahead of their results tomorrow, as to frame some context, Tom, as to why maybe it is run as strongly as it has, whether you think it's worthy, and, you know, any remarks, you know, pertaining to electric vehicles, you know, that might be relevant in the way you've set the fund up, any other holdings that might be derivative plays or what have you?
I certainly have lots of thoughts and comments. I'm just trying to share a couple of slides here from another presentation while I'm talking. Hopefully you can tell me if this comes up. Yeah, look, we haven't benefited from the rally in Tesla. We are big believers in the adoption of electric vehicles globally, and you've got to respect what Tesla has achieved in that space, and its products are fantastic products. we've always struggled with the way that the stock is priced, the valuation for that company. And that is, more so today than it's ever been. And I haven't sort of redone this calculation in the last week, but a week ago, Tesla's market cap valuation exceeded, the total market capitalisation of Volkswagen, Mercedes-Benz, BMW, Fiat, Renault, Peugeot, Ford, GM, and in effect, all of the European and US auto industry. And similarly, it was about on a par with the entire Japanese and Korean auto industries. And that's extraordinary for a company that's making less than 500,000 vehicles a year. And our view, and perhaps where we've been wrong about Tesla to date, has always been that as all these other companies spend quite literally tens of billions of dollars developing their own electric vehicles, that Tesla would ultimately come under increasing competitive pressure and start to lose market share. And at the end of the day, it's a relatively capital intensive business making cars, and that they wouldn't be able to sustain the kind of, or perhaps ever achieve the kind of returns on capital you need to have a company that's worth as much as Tesla is being priced. And I mean, what's happened recently that sort of played to what's going on with Tesla, the competition has come. There are a lot of good electric vehicles out there now. There are a lot more to come, but recently Tesla, for a variety of reasons, has actually increased its market share in the face of that. It's got to do with the timing success of the Model 3 and its growth in China, and being in particular areas where subsidies have been very favourable for it. And that's great. They've done very well, but we struggle with that valuation. We've more looked to where we can get exposure to that industry through suppliers who are likely to benefit from a shift towards electrification. So things like manufacturers of connectors or electric motors or components, materials, whatever, that go into electric vehicles, and to buy them at prices that don't reflect the growth that is likely to come from that. And that's been a challenging approach. We don't have a lot of exposure in the auto sector right now because at an overall level, auto sales are reasonably weak globally, and that hasn't picked up. But it's an area we continue to focus on. I came across yesterday a very interesting Japanese business we're not invested in. It's a little bit small for the fund, but it's very sort of illustrative of the kind of thing that we would like to own. It's a Japanese company called Otawara Engineering. I'd never heard of it. Happened to be in a Wall Street Journal or Bloomberg article. And it makes winding machines for making electric motors, so winding the copper onto the coils to make electric motors, and it stands to benefit significantly from growth in the use of electric motors in transport and in a pretty wide range of other in-market applications as other things electrify. And that's a company that is, like many industrial businesses, suffering a short-term pullback, but it's trading on, or was trading on, something like 10 times its earnings from 2 years ago, which is to us a lot more attractive proposition to buy a company like that at that kind of valuation with good prospects than to go chasing Tesla on a valuation that's sort of going to be very hard to live into.
Yeah, it's amazing the concentration in the market at the moment. There's a few questions coming through, Tom. I don't know if you can see them, but I'll start with the one at the bottom only because it's relevant to the last comment you made. The first question: does the fund hedge out currency risk? But the second one: does the fund have any liquidity issues with investments in smaller companies?
The answers are pretty straightforward. We run the fund as an unhedged fund. So there's no currency hedging. We certainly monitor currency exposures, and like our sort of broader geographic diversification in the fund, we're seeking to provide currency exposures that aren't sort of too heavily mismatched from what you would see in a traditional global equity portfolio or global equity benchmark.
Yeah.
We do look at currency when we look at companies, and if you get points in time where there are extremes in currency, we will typically look to find companies whose earnings might benefit from that, or if there's potentially going to be a reversal in currencies and that's not priced in, that we'd look to find the companies that might benefit. In terms of liquidity, we don't have any issues. So the funds investing in companies of all sizes, but at the lower bound, we don't often invest in companies under about $1 billion market cap.
Yeah.
We can go down to 200 million, but we haven't done so for a long time. Yeah, we offer daily liquidity to our investors, and the portfolio reflects that.
Yeah.
There's no doubt there's no doubt a very interesting opportunity set at the small cap end of our investment universe. It's much much lower liquidity, much higher volatility, much riskier, maybe potentially higher returns in some of them if you can get it right. With this fund, we've stayed away generally from that part of the opportunities, partly because history says a lot of those companies end up failing because they're operating in competitive global industries, but partly because we're trying to put together a product that is sensible and relatively low risk and usable for you and your clients.
Yeah. A question from Paul. Tom, do you have an opinion on large solar power investments in sun abundant states such as the Northern Territory and Western Australia?
I think it's a really interesting challenge for Australia. There is no doubt that large scale solar projects in Australia can generate cheap electricity, and that done right, we can use that electricity in a way that should help our economy. I'm a little cautious about the prospects of some of the projects that have been announced that are talking about exporting that power via high voltage cable up into Asia, and some of the things for which they were sort of talking about using that power, including hydrogen generation. And I'm cautious for two reasons. One, the cost of transporting either electricity or hydrogen is pretty high. And so if we do those things, there's a good chance we're ultimately not cost competitive in those global markets if we have to bear a high transport cost. And the second is that the timeframes to potentially develop some of those projects are very long, and the cost of solar power and perhaps other forms of generation and the cost of hydrogen will come down dramatically over the next decade around the world. And I think we've got to be very cautious in this country that we don't invest hand over fist based on today's economics, in the hope that today's economics might be the economics of a decade's time. So solar power today, you can generate in Australia at large scale for probably 4 cents a kilowatt hour. In other parts of the world, that's closer to 2 cents a kilowatt hour, where they've got cheaper land, where they've got cheaper labour, where they've got particularly cheaper financing costs. And that cost is going to come down. So in Australia, it'll come down, but in the Middle East, it wouldn't surprise me if you see solar generated electricity in 5 or 10 years' time at 1 cent a kilowatt hour. And it's going to be very hard for us to compete. If we build projects today at 4 cents a kilowatt hour to make hydrogen and ship it around the world against projects there. But yeah, I think in Australia, it's about finding value add products with relatively low transport costs. So things that are more dense and more valuable that we can export successfully, having produced here. So I generally like the idea, but I think warrants some caution.
Yeah. Peter, I'll get Tom to answer actually, maybe we can do it now, but Peter's just asked any interest in space technology. It's a general question, but I'll defer to you on that, Tom, since I'm not quite sure what tech that is. But is there anything there that you?
Only in the sense that we do look at wireless connectivity, and if you look at the suite of solutions that includes low Earth orbit satellites, and we've looked at businesses like Inmarsat historically that provide global communication sort of satellite services, and we've had them in our investment universe, but more broadly, no, we haven't paid a lot of attention to it. There are very interesting developments going on in that space. Most of them aren't accessible in the public markets, and they're challenging propositions from an investment perspective because they're extremely capital intensive, and there's some big unknowns about the rate of sort of take up of those things that you have to make some bold predictions to justify investing in those areas.
Can I, William? I'll defer to. I'll defer to. Maybe we'll come back to your question because it's a long one for Tom privately, if that's okay. Can I just get, because I love hearing, Tom, when you go into the detail like you just did there on solar, which is really interesting contextually. Can you just give the guys, just to finish it out, just a bit of an understanding for the expertise within your team? You've got guys in London, obviously yourself as well, but just a bit of a background because it does involve finding new technologies, and I think there's a real specialist skill set that you guys have. It'd be good for everybody to understand.
Yeah, look, we've got a sort of broad mix of experience and skill sets across our investment team and indeed across the firm that I think is relevant to what we do. There's a technical element to looking at a lot of these things. I'm a mechanical engineer by training. Paul Chadwick, who's our managing director, is an aeronautical engineer. His claim to fame, apart from in the investment space, was designing the wing of the 737 back in his day. That provides me with some grounding for assessing, whether solutions are likely to be, feasible and are sufficiently sort of elegant from an engineering perspective to succeed. And going back in time, and I think we'll see this again in things like hydrogen, there was huge amounts of money put into things like salt thermal technology, heating up salt to run, to produce molten salt to run steam turbines. From an engineering perspective, that's extremely complex and comes with a whole lot of risks that people, I don't think, generally appreciated. I've been looking at this sort of technology set for a decade now with others in the team, and we've developed a good understanding of what's happening. I think that sort of one of the insights is a lot of the, and I tried to refer to this earlier, a lot of the technologies that will change the world, in fact, just about all of them, are technologies that exist today. This is not a game about trying to work out whether some new technology is going to work or not. When the scientists and the CEO of the company developing it can't tell you whether it's going to work, we don't purport to have that level of sort of technical understanding. But solar technology has been around close to its current form for 50 years. It's not new technology, and it is understandable, and you can make better judgments about that kind of thing without having that. But we also have experience in sort of economics. So one of our investment team members is based in London. He's a Oxford economics honours graduate. He worked for McKinsey. His sort of angle on the world is often through looking at industry economics and company economics, and ultimately that's what ends up driving investment outcomes in most cases, is how the economics of industries and companies evolve over time. And so his sort of insights on that front are pretty valuable. Tristan Patience, who's our Sydney-based portfolio manager, as a mathematics medal. He has a much more sort of quantitative approach to tackling the investment challenge, and does that in a way that allows us to sort of look across 1,000 stock opportunity set and narrow it down in an efficient way to things with the kind of financial characteristics and valuation, that we're seeking out. And then our most recent hire in the investment team is a woman called Jane Henderson, who worked for quite a long time in London for Norges Bank Investment Management. And you may be familiar with the Norges Bank Investment Management, run the Norwegian Sovereign Wealth Fund, and they've been a thought leader around ESG and environmental investment for a long time. She ran a global portfolio for them and comes with sort of that experience and a focus in understanding consumer end markets, which are ultimately important to quite a lot of our investments.
Awesome. Well, I think we might leave it there. William, as I say, we'll get your question offline. Before I hand it back to Simon, I mean, thanks, Tom, for taking the time out to do this. As you sort of were implying earlier, there's a couple of other firms that are really quite interested in your thoughts as well this past week. And I really think, from my standpoint and from the investment committee standpoint, the last week or 10 days with many of the policy announcements coming out, as I say, particularly from Joe Biden, but also last night on the EU side, that this is a really, this is a space that's really hotting up now, and your collective skill set makes you, I think, a really standout firm for investment over the next few years. So listen, thanks very much for your time, Tom. Really appreciate it, and hopefully for those of you that attended, you got a lot out of it. Simon, I'll hand it over to you just to finish up if it suits.
Great, thanks, Jonathan, and thanks, Tom. Very much appreciate the time and effort that's gone into it, and thank you to everyone that's asked some questions. And William, you're always very good at asking some very good questions. So we'll get Tom connected to you offline. And to answer my part of the question, Buddy, my dog, is well. Thank you for asking about him. He's growing very quickly. So just in terms of our next session, we've got the next presentation in around about 4 weeks. The next presentation will focus on property, all forms of property, but importantly give clients a bit of a view from an expert, David McMillan, around residential property, where there's a belief as to where that might be going. There's some additional data that's been attained over the course of the last 3 to 6 months during COVID that I think will be useful for all of us. A lot of us are obviously property owners, so it'd be good to hear from David. If you have an interest in attending that session, please register. You'll receive a link for that. But again, thank you so much, Jonathan, for leading our discussion today, and Tom for presenting. I'm sure we all learnt something new, and we look forward to continuing to support your fund. The clients have had a good experience, and we'll continue to do so in the future. So thank you everyone for attending, and we all look forward to speaking shortly.